Learn Accounting Podcast by Professor of Accounting. This is episode 14, IAS 7, Statement of Cash Flows Pro-forma. So I just want to emphasize first, this topic is purely about cash. I know we deal with profit, and you've had a lot of questions on profit in IAS with regards to income statements, but this is focusing and giving a degree of importance to cash. So I always start off with the kind of question, cash versus profit, and talk about the differences. But a little example I can throw in is the effect on cash. So let's just look at the a company in terms of the bank balance at the start of the account period. Let's say it's £20,000, and at the end of the period it's £10,000. So first of all, what is the change? The change in that period is £30,000. So the company should seek the cause of the change in the bank balance. So not just accept it because they've paid things and the bills and so on, cash has left the business, then they should actually know why. So it's actually justifying what was the reasons for the money going down, especially. It could easily have gone up by 30,000. So what is happening there? What are we paying for? What situation? If I then tell you that the business makes a profit, whether that's a good amount of profit or not is irrelevant. In my example in this case, it's just the illustration that even though a business has made a profit, their cash, their bank balance has gone down and it's gone negative. It's an overdraft, which is an adverse situation. It's not usually not a good position to be in, but depends upon the actual company's situation. So the question you should be asking yourself, a cash flow statement is needed to explain why, after a profit of £8,000 was made during the year, the bank balance decreased. So a cash flow statement, not a forecast, completely different, a cash flow statement. This is going to show you clearly now in the way in which £20,000 became £10,000 for the period. So maybe, you can't show you these numbers, it's just a basic example, but there's a very clever element to the layout where if you know the bank, you should know the bank balance at the beginning and end. You're just basically now working out in the cash flow statement. All of the structure which I'm going to show you now is showing you the difference, although where 30,000 has gone to. So let's start off with a look at the overview of the layout. So here's the structure. Here's the you've got to break it down into making it easier to learn. You can't learn the whole thing in one go. So here's the first section. So the overview of all three sections. The first section is the operating activities. And what goes in the operating activities? Well, it's the main revenue producing activities, which I'll show you in the layout on the next slide. You've then got the investing activities. So that is, you're producing the statement of cash flows for this company. Well, that's that company investing in other companies. So if they're investing in other companies to make profits, then they may obviously receive a dividend. If that other company is profitable, so it's dividends received. So I don't think it's happened yet where dividends have been received in questions yet for AQA. But don't just ultimately think that if a dividend is given on the page, that it's dividends paid to our shareholders. It could easily be received by the company. So we'll go in this section, not the financing section next. So investing activities, this is the acquisition, i.e. the purchasing and the disposal, the selling of non-current assets, fixed assets. So obviously if we're investing, then we're spending money on buying fixtures and fittings and so on, machinery, as well as what we just said there, other investing. So dividends received is the clue in the investing section. In the financing activities, this concerns issue of new shares, that's selling shares. We've got bonus issues and rights issues, but remember, bonus issues, you don't raise finance. A bonus issue is free shares to shareholders, but whereas a rights issue does generate cash. So there could be a rights issue, maybe say SAS work, so they could bring that in to make it a bit harder. And dividends paid, so we look at it from our point of view as the company, so it's our company we're working for is paying dividends. That will go in the financing activities, as well as any changes in long-term borrowing. So typically you get long-term loans and you get debentures. I don't think you get mortgages, or rarely would you get mortgages, commercial mortgages. That's the three sections. The last section, I suppose it is a section to an extent. The bottom line, you've got to state, working out the maths, the net increase or decrease in the cash and cash equivalents. So in this case, looking at rather than do the full numbers, but my example at the beginning, it was £30,000 difference. Well, that would be the answer. It'll be a net decrease in cash and cash equivalents, and it'll be negative 30,000 or negative 30 with a key of 3 zeros. But that's what we're doing in that section there. Let's start with looking at the first section, layout. Operating activities. So layout as it is, we're starting off the layout in full. This is going to be slide by slide, and if you put all the slides together, if you print them out or something, then they just literally fit one underneath each other, which is the two columns here. So we start off with what I call NPBIT, net profit before interest and tax, which is operating profit. We're adding back the depreciation charge for the year. Why do we do that? Well, depreciation is a non-cash expense. Cash is not left the company, so it's added back to profit. Same for a loss on the sale of non-current assets. Again, a loss on the sale. This is about income because we're selling current assets or fixed assets. So if it's a loss, we're adding it back to profit. However, we could gain, we could make a profit. So therefore, it's the opposite. It's deducted. So I've just gone for the adding because it makes the column all positive crosses. If crosses can be positive. So a loss on the sale, but we would deduct a gain. Let's look at the inventory. So, and I'll go through why it is the way that it is, because some of these are not too clear. I have to take one way and look at it. A bit easier than the other way. So we're adding a decrease in inventories. Why is that? Well, inventories, if they've increased, so let's look at it this way first, a bit easier rather than the decrease. If inventories increase, then that's using cash. So if you're increasing inventories during a period, then at some point you're going to have to pay for those. And it's that the time element is at some point. Well, when? In 1 year's time or 2 years' time? No, it's within 1 year. So within 1 year, cash must be used to pay for those inventories. So if the company is spending money on those, which they're not going to default on paying their creditors the money they owe for stock, so the company spends money on those, so therefore net profit is decreasing. But likewise, like in the layout, we've got a decrease. So if inventory is decreased, then it's a cash inflow. It's said to be a cash inflow. Why? Well, why is inventory decreasing? It's typically because they're being sold for cash. So if at the beginning it's one value, then at the end of the period it's a lower value. It's lower. I know you've got the argument of how much you buy compared to how much you sell, but we make it clear and simple in this case between the two issues there. So if the inventories are decreasing, it's a cash inflow because it's being sold for cash, so it's generating money. And again, if you look at it in this case, what about a credit sale then? Well, if it's a credit sale, you're not getting cash immediately, but you give credit to your debtors and you only give them 30, 60, maybe now, it's not as common now, 90 days to pay. So if you're giving them that length of time, it's within 1 year, it's within 365 days, very much so with that time frame. So that's going to be an inflow at some point during the year, so that's why it's a cash inflow. Next, a decrease in trade receivables. I remind you, trade receivables, what is that? That's debtors. So let's look at it in terms of the two sides. If we decrease, if trade receivables with debtors, if they decrease, this is a cash inflow because the company is financing less receivables. Trade receivables, that is. So they could be two ways of thinking of this. They could be allowing the debtors less time to pay. So if we give them less time to pay, the debtor value at the end will be lower than it was at the start. Because they're getting less time to pay, so cash is coming in sooner, so the value of debtors would, compared to the previous value, would be smaller. By how much, we don't know. Or they have the decrease in credit sales. So what else could affect the closing balance of debtors in this case? Well, what if we don't sell as much on credit? So if we don't sell as much on credit, then the debtor value will be affected. So in that case, if it's decreased, its credit sales, that we add that back to profit. So that's the example I've got in the layout. We add a decreased trade receivables, keeping it positive. The next one, we've got the trade payables. So the clue there is it's the opposite of the trade receivables. So if we add a decrease in trade receivables and we add an increase in trade payables. So why? So trade payables creditors, if they've increased, is a cash inflow because either the company is paying its suppliers more slowly. So if we pay them slowly, think of it that way, then the value is going to rise because we still owe more. Or the second thing, I mean, it could be this or it could be both factors working together. There's an increase in credit purchases. So if credit purchases are increasing, we're buying more from the creditors for whatever reason, then the amount we owe is going to rise. So the rule in that case, we add an increase in trade payables. We add those values together. So remember, if there were any negative values there to subtract, in that case, subtract a value, be brackets around the cross. which is the real number, and we add them up or add them back in this case to the profit from operations NP bit, and we get cash from operations. I'm going to give you an example on to produce this layout as it is on the screen now, a question on the next slide, to work from the profit or loss from operations before interest and tax all the way down to the cash from operations, just to test it, just to test the basic awareness of the adding and decreasing of the adding and subtracting of the decrease and the increase, just to test that on the line. However, this layout is not finished yet. We've got a few more lines to add in. We then, at this point, we then look at what was paid. So we deduct the interest paid, and it was paid because we have to pay interest, so we're taking it away from the cash because it was paid, and likewise we're taking away what tax we paid. Those two values will be negative because we're not paying them. Obviously, if you have them in this case, and in the example I've got for you, they're not in there. I'm going to cash from operations, but that is the last two lines apart from the total, and the total equals is net cash used in or from operating activities. So the value there, just to clarify the term, they do tend to leave the equals and that whole net cash used in from in one line, but really it's explaining what words you use depending on the number. So if the bottom cross at the end here, if that was a negative, which is possible, then you would use net cash used in operating activities. If it was a positive like it is, then you just use net cash from operating activities. So substitute the value that's needed. So just to emphasize, read this again until you fully understand what the effect of this is. Try and use look, cover, say. It's a basic way of learning. Look, cover, say. It's very useful. Look at it, cover it up, say it, write it, and hopefully that is a good way of trying to memorize this, because this is only the first element of the first part of the three for the layout. This section, what is it called? Well, you're given this, it's good to learn this, but typically in questions they do give this in the question, so you can take from the question to do a title. This is the reconciliation of profit from operations to net cash flow from operating activities. It's a big mouthful in what you're saying, but break it down. What is it? You're going from profit from operations at the top, and it's to the net cash flow, which is difference between the operating activities in this case. So you just describe what you're doing there, and titles are important, so do put them in. Maybe there's some marks attributed to that. Okay, that's the first section. So here is the example. You've got HP, and it wants you to prepare the cash operations. So here's the information I give you, and the answer. Right, so pause it now and complete the what I'm asking you to do. Hopefully you can commence and start it. I'm just testing, do you add these values together or do you take them away? Just look at the whole information, use my example and layout, and tell me from using these values what the cash operations value would be. So pause it now, answer your work, and then replay this, and I'll just continue on and give you the solution. Okay, so if you've done your work, hopefully you have attempted it and tried to complete it. Here's what you should have got. First of all, the first adjustment, the profit from tax, we need operating profit. So if we've got the 137,200, that's after 2,500 of interest has been deducted. Well, we don't want that. We don't want to have deducted the interest. We want to have operating profit. So we therefore add back the £2,500 and increase the value. The depreciation is given, so we've got to add that back. Next line in the layout we got is, well, I did mention disposals or gains or losses. Well, there's nothing in there, so you just don't include it. Only use what you've got. So we've got the non-current assets depreciation done. I'm giving you a decrease in inventories, so the rule there is the 3,500 is added. The increase in trade receivables, well, this is the interesting one, because I gave you a decrease in trade receivables in the layout, which is the common way of looking at it, or the way we add the value back. So an increase in trade receivables will be a deduction. So you add a decrease, so you minus an increase. Okay. The increase in trade payables is 4,000, and the increase means we add. In this case, that's all I want you to get. I didn't want you to go any further because I asked you to prepare the cash from operations. So you could have done the title at the top, or the side title, so you don't need to put anything at the bottom here, but the answer is 157,200. A basic question, that could be part of an exam question. It's by no means a full exam question, but certainly that it's a starter question for you to get your head around the topic and the terms and the approach to answering these questions. Okay, let's move on to so this is, again, I always reproduce this again. Typically I get students to review it and go through and test themselves what's next. So at this point I would have done that. I was going to go through it. Hopefully you've getting familiar with this and you're starting to learn it. Let's move into section 2. What we've done there is section 1, the first section. The second section next, it just goes right underneath where the black line is, without the line there, and continue on. So here's the second section, which is the investing activities, 2 columns still. So here we go. We deduct the purchase cost of called PPE, the property, plant and equipment, and intangibles. Well, that's sensible. We deduct because it's a cash outflow we're buying. We add the proceeds from the sale of property, which is PPE, and intangibles. So if we sell, then that's gains. Well, I say gains. It's not necessarily the gain is the profit. This is the proceeds. So the money we received from what we sell. So not the profit element there. We add the interest received. Any interest received we add, we increase. Notice where they're going. They're going in the left column. We add the dividends received, and then we get, in this case, we get the net cash from or used in investing activities and move it to the side. We then look at the financing activities layout. Okay. So we've got the cash flow from financing activities is the side heading. We add, proceeds of issue of equity share capital. So how much did we receive from selling shares, basically? And that could be a rights issue, it could be normal selling of shares. Bonus issue, you don't get any money from that, so you can't have that. We deduct the repayment of share capital. So that in the sense of maybe someone has sold the shares back to the company, so we are giving them back the share capital amount. So it's deducted, it's a cash outflow. We add the proceeds of long-term borrowing. So obviously proceeds is that's receiving long-term borrowing. So if we take out a loan, then we want to receive that money, so it's an increase. We deduct the repayment of long-term borrowing. So don't get confused with that. That's not the interest. Repayment of long-term borrowing. I know you, in typically way of thinking of repayment of borrowing is we pay what we need to think of it as is we repay the actual loan amount as well as either a separate payment for or a collective payment for the interest. This is only looking at the actual borrowing amount, not the interest. So the repayment of the long-term borrowing, which is paying back a loan, for example. We've got it's a cash outflow. Dividends paid, so that's in this case dividends paid buyers because we're filing, so we're paying out. And that equals, again, net cash from or used in finance activities. So I'd use net cash from because my X's are positive and I'm going to keep them positive. But if you get a negative value, which you can do, put it in brackets and use used in. The last section here in this case, so I mean, before we just go on to this, just please look at the dividends twice. You've got dividends in the investing, you've got dividends received because the company's investing, so they're entitled to receive a dividend, but it's not legally binding because if the company that they're investing in doesn't make a profit, they can't get a dividend. And we typically, I said that very simply, that we typically think of them as ordinary shareholders rather than preference shareholders. Whereas preference shareholders, they typically do get the agreement of paying the dividend because they know upfront how much they're going to get. So the dividend received is in the investing activities and the dividend paid is in the financing activities. I just say that because we've yet to have a question in AQA where they mention both or one, maybe the received, I think it's dividend paid tends to come up, and you have to remember where they go. Next, this is the last section, so this is the last calculation. What we need to see 3 lines. Net increase in cash and cash equivalents. Well, that value is, in this case, the value given, it's using the balance sheets, or a list of balance. It's this is, I should say, the net increase, change in the values above. So that value above the net increase is the 3 values you got across for the financing activities, net cash used. You've got a cross there at the top for the net cash from investing activities, and then you've got the cross from the first layout I gave you on the other slide. So the net increase would be the addition of all those values, taking into account any negatives. So the cash and cash equivalents at the beginning of the year, that's what you get from the balance sheet at the beginning of the year, and at the end of the year, you're given that the balance sheet at the end of the year as well. So if you just remember, the first example I did in this podcast was my cash versus profit. These 2 values, I'm going to move them off the slide in a minute. This one and this one. So this one and this one, the beginning and end, that would be the 2 values I had, which if I remember now, I think it was £20,000 at the beginning, and then it was negative 10,000 at the end. Yes? So the difference is 30,000. So if you use my example at the beginning to understand this, I know you haven't completed all the layouts, but these last 3 lines, this one, and this one, what would my numbers be in the first slide, or where would they go in here? Well, this value there would be the negative 30,000, because that, well, it wouldn't say net increase, it would say net decrease. So that would be negative 30. This would then say the £20,000 positive, and then this one would say negative 10,000, because that's what it is now. So it's so important. You can get these numbers straight away from the balance sheet in the question immediately. And I strongly recommend students do this, because you're then looking, you've got the answer at the end and you're looking backwards. And again, I know you're looking at crosses on the page here, but it's so useful to do this. First of all, work out the change in the cash and cash equivalents, and then you're looking for, in this case, if you knew it was negative 10 at the end and then 20 at the start, you know it's a £30,000 difference. So you're looking at, from the three X's, and in my case, the three sections, you're looking to get a difference between them all of the negative 30. So it's so useful to do. Again, to reinforce my point there, I will try and do a podcast related to that with actual numbers. So that is the layout. I'm going to do another podcast as well to follow on from this with some useful tips and technique and approaches in rather than just put numbers in lines and values and take them away. That you have to do quite a lot of number crunching to get the values to use. So I want to thank you for stopping by and watching this podcast. This has been me, Professor of Accounting. Hopefully you found this useful, and I'll see you next time for another podcast.